There's a lot of U.S. economic data that came out this morning. I've got a lot to unpack here today. Today, we saw inflation, we saw incomes, and we saw spending. These are all sending signals about where the U.S. economy might be headed as we close out 2024. Now, some of the data this morning, it did look pretty solid, but I can't help but wonder here if we're maybe getting a little bit too comfortable too soon. I want to take a closer look at each of these. I want to start with the core PCE price index. And this is the Federal Reserve's go-to metric when it tracks inflation. In October, it rose by 0.3% from September. That's exactly what we saw last month. Now, on the surface, that sounds pretty stable, but here's the catch. The year-over-year rate climbed to 2.8%. And as you can see here, that's now the highest in 6 months. Here's how it breaks down. Service prices, they were up 0.4%. That's becoming a bit of a recurring theme here. Meanwhile, we saw goods prices actually drop by 0.1%. Now, when we look at this and we think about the decline in goods, that might sound like a pretty good thing in the short term. It probably is. But let's not forget that we're seeing service prices. They've been persistently climbing now. We're talking about things like rent, healthcare, entertainment. These are where people are really starting to feel the pinch, and it doesn't look like there's any signs that these are going to be cooling off anytime soon. And honestly, when I look at this, I'm concerned that it could be a sort of a quiet setup for inflation to come back stronger than any of us would like. For sure, goods prices, they may be a bit softer right now, but if demand picks up again, we could see those costs rebound. Then if you combine that with the steady rise in the service prices that we're seeing, we might not be our inflation might not be quite as in control as it seems to be. Now, if we look at the income side of things, they were actually surprisingly strong. We saw personal income rise by $147.4 billion. That's 0.6% in October. That's the biggest jump now in 7 months. That is also double the growth rate that we saw in September, well above market expectations. So again, this looks like good news. Maybe it is, maybe it isn't. Here's what is driving this. Wages and salaries, they increased by 0.5%. That reflects some ongoing strength in the labor market. Interest and dividend income, that was up too. Dividends alone jumped by 1.3%. And then we saw disposable personal income. This is what people have left after taxes. That grew by $144.1 billion or 0.7%. So on one hand here, yeah, it's great that we see Americans with more money in their pockets. That's probably pretty obvious. But on the other hand, I can't help but wonder how sustainable this is. I think a lot of this growth is happening despite the higher borrowing costs that we're seeing. It now looks like those interest rates might not be going anywhere anytime soon with this latest economic data that has come out. If we see wages investments take even a slight hit here, that could change things pretty fast. Then the third piece of information out this morning is spending. Personal spending rose by 0.4% in October. That's a bit slower than the upwardly revised 0.6% that we saw in September. Here's the kicker though, it still beat expectations by 0.3%. If we take a closer look at this, we'll see that spending on services, that was the biggest driver here, up 0.5% to an annualized $13.8 trillion. We saw spending on goods, that was flat overall. Durable goods, we think of things like appliances and cars, they increased 0.3%, but non-durable goods like groceries and fuel, they fell 0.2%. Now, here's my take on all of this here. People clearly here are prioritizing services, things like travel, dining out, entertainment, but they're cutting back actually on things that they can delay, like buying new clothes or upgrading appliances and gadgets. That shift does make some sense to me, but it could also be a bit of a warning sign here. If we see people start tightening their belts even more, we might see spending falter here. Let's not forget that consumer spending is a huge driver of the U.S. economy. This really now is sort of where my skepticism kicks in here. The Fed, it might feel pretty good right now about seeing inflation sort of under control, but service prices are telling a different story to me here. When we look at the spending numbers, yes, they're solid for now, but what happens if income slows down or if borrowing costs finally catch up with consumers? If inflation, this is my big worry here, if inflation does make a comeback, the Fed would either have to suspend the rate cuts that we've seen recently, or in the worst case scenario, they'd have to start raising again. Now, the next few months, that's going to be crucial to the equation here. We've obviously got holiday spending just around the corner, probably already here. That could either reinforce this economic strength that we're seeing, or it could also expose some cracks that we may not see on the surface here. Like I say, if inflation, if it doesn't stay contained, or if income or spending lose some steam, we could be in for a rougher start to 2025 that a lot of people are expecting. What do you think? Are we heading into a strong finish for the year, or is this all a little bit too good to last? Let me know what your thoughts are in the comments. Investing is very personal. So whether you're just starting out or whether you've been at it for years, your financial goals are unique to you. Maybe you're focused on diversifying your portfolio. Perhaps you're just seeking a strategy that aligns with your values like socially responsible investing. Well, BMO ETFs and mutual funds, they offer solutions that are tailored to fit where you are in life, where you want to go. With BMO Global Asset Management's experienced team at the helm, you're not just buying into the fund, you're gaining access to insights that can help navigate the complexity of today's markets. This is more than just about investing. It's about making your money work for you in the ways that matter most to you. Don't wait. Discover how BMO ETFs and mutual funds can help you achieve what's important to you. Visit bmogam.com. That's BMOGAM.com today to learn more. A quick note here before I get into my next story. A reminder that next week, Brandon, and for those of you who might not know, Brandon is my son. He's the founder of this channel, and he'll be sitting down with a Canadian legend, former Dragon's Den star, best-selling author of The Wealthy Barber, David Chilton. And this is a completely free session. It's Tuesday, December the 3rd at 6 p.m. Eastern, 3 p.m. Pacific. And this is one session that you don't want to miss. I will put an RSVP link in the description of this video. I want to have a look now at the latest Equifax Canada's Market Pulse Consumer Trends Report that's just out. And the good news first, interest rate cuts from the Bank of Canada seem to be making a difference out there. In particular, mortgage holders are starting to see some relief. We saw the delinquency rate among them slowing, or year-over-year increases dropped from 11.7% in Q2 to 9.5% in Q3. So that's definitely a win. But there is a flip side here. We're seeing delinquency rates overall, they're still slightly higher than they were even pre-pandemic. Over 1.3 million Canadians missed a credit card payment in Q3, and that's up a significant 10.6% from last year. Let's talk now about the groups that are facing the biggest challenges. Newcomers to Canada, those who have been using credit for 12 to 36 months, saw a spike in missed payments. In this group, 1 in 22 consumers missed a credit payment in Q3 2024. You can compare that to 1 in 28 just last year. That shows a pretty clear trend. Why is this happening? Well, rising unemployment, inflation, they've obviously added a ton of financial pressure. It is also worth noting here that newcomers opened credit files during the peak immigration years in 2021 and 22. And arguably that is one of the most challenging economic periods that we've had in recent memory. Now I want to look at the overall debt. Canadians' total consumer debt hit $2.54 trillion in Q3 2024. That's up 4% from last year. A big driver of this is auto loans. And non-bank auto loans, they jumped 12% year over year, while bank-issued auto loans rose by 2.7%. And this increase aligns with better affordability in the auto market thanks to the falling used car prices that we've seen and some improvements in financing deals. Credit card debt itself overall is up 9.4% year over year. What does this all mean? That's the bottom line here. For one thing, the slowing delinquency rates in mortgages, that sort of is a good strong sign that the Bank of Canada's rate cuts are starting to work. But then we contrast that with the persistently high overall debt delinquency rates. That means that the financial pressures aren't really easing evenly across the board out there. And that could complicate the policy decisions that we have moving forward. Some Canadians are tightening their belts. Others seem to be taking on more significant debt. As I mentioned in the previous story, with the holidays fast approaching, we could see financial pressures grow there. And as Rebecca Oakes from Equifax Canada points out, those who get into debt are finding it harder to get out. And that's a sobering reality for a lot of Canadians. I want to end this segment here with some insightful words from her. She kind of sums everything up. She says, while recent rate cuts have alleviated some of the strain for some people, the financial pressures on Canadians remain significant. We are seeing that those that get into debt are having a hard time getting out of it. As the holiday season approaches, consumers should consider their personal financial positions when making spending decisions to avoid financial strain. Just a quick update here on the ongoing postal strike. News out this morning that the mediation efforts to resolve the strike have failed. And Labour Minister Stephen McKinnon, he's summoned Canada Post and the Canadian Union of Postal Workers to his office after these federal mediation efforts have hit a wall. McKinnon says that the special mediator has concluded that the two sides are just too far apart on critical issues for mediation, at least at this point, to be of any use. As a result of this, a mediation has been paused until productive bargaining can resume. And he emphasized that both parties bear responsibility for the impacts of the ongoing strike. Now, the union itself, it represents 55,000 units, is pushing for a fair wage and better working conditions. Canada Post, on the other hand, they argued that these demands would bring heavy costs and create inflexibility in its operations. So even with this current standstill, McKinnon, he says that he is hopeful that the mediator can re-engage with both sides when they're ready to negotiate meaningfully. For those of you who aren't subscribed to our Pulse newsletter that comes out every weekend, I will put a link here where you can stay up to date on that. As always, thank you for watching. We'll see you in the next video.